and then we'll get started. Thank you for joining us for the free lunch webinar series, Farmland Leasing. We are grateful to have Dr. Chris Clark from UTIA joining us as today's instructor along with us. Along with me, a few housekeeping items. Please leave your microphones on mute and video off during the session. If you would like to locate a chat box right now, please type your name and location into the box to help me record attendance. You can use it at any time during the session to submit your question. I am recording the session and plan it to post it online. So if you like to view it again or share with someone else, feel free to do so. I will ask you 2 questions at the end of the session to help me record feedbacks. So if there are no questions at this time, let's dive into today's session. We're going to be talking about how to figure out a fair rental rate. In the first session, I actually did this survey to ask you all if you're a landlord or tenant. And actually 2 out of the 10 answers I got are tenants. And the majority of the participants here are actual landlords. So we're gonna mainly be talking about, as a landowner, how to figure out a fair rental rate, but also introduce some tools for the tenants to utilize if you're interested to use those tools, but we won't be concentrate too much on those tools. So we'll just do a quick review of the lease types we talked about last Thursday. And we're going to talk about how to determine fair rental rate. And I'll use examples to illustrate that. And today the session will probably last 4 to 5 minutes and we will not rush. I'll try not to rush like I did last time. So if you have any questions, just type in the chat box. So last Thursday, we talked about there are 3 main leasing agreement types of leasing agreement: cash leases, crop or livestock share leases, or hybrid leases. And cash leases has 2 categories: fixed cash or flexible cash leases. With fixed cash leases, rent is predetermined or fixed. And there are different ways to even determine what is your fixed cash rental rate. The majority of us probably use the first type of method. You can use prevailing or market rental rate that in your area to determine your rental rate. So that requires your general knowledge of cash rents being paid for cropland in your area. And adjustments in rates should be made for differences in land productivity. And I'll use example in the next slide to show you what that means. And the second, you can, and this is my own preferred method for a landowner, that you need to calculate what is your cost and have an idea what is the minimum or what is your bottom line, and figure out what is your tenant's ability to pay also to give you a threshold to work your negotiation to work between. So it's important to know how to calculate your landowner's cost of ownership and also have a general idea of how much the tenants, what is their ability to pay, and just negotiate. That communication is important. So prevailing cash rent example. This is one of the publication UT publish every year to give you an idea what is the average cropland or irrigated cropland or pasture land rental rate per acre for by counties. So you see I highlighted Montgomery County, that's where I live. And you can see that for non-irrigated cropland, an acre is going around $118 per acre. And a lot of times, number one question actually got asked by a landowner that is doesn't have that much ag knowledge. It will ask me, well, what does that mean? Is it like $118 per year or per month? Because we're so used to the monthly rate, probably for our apartment or condos. But for agricultural land, 118, that's per year, per production year, because the crop, it's not like you can harvest every month for the row crop. So that's how it's determined. Um, for Montgomery, example for pasture land, the average rental rate for 2019 is around $23.50. And you can see the right-hand side is 2020. The survey shows the land rent increased by $2 for non-irrigated cropland. And for pasture land, it also increased on average $2 per acre. So that information you can find at the link below this slide here. And I can also send you this publication for last year. So the second method I talked about, or I recommend, is to calculate your landowner's costs. And what does that look like? So this is a worksheet developed by Michigan State University. I can also share this worksheet with you. So include a couple things that you need to include in your cost calculation. First, what is your property tax paid on the farmland annually? And then, what is your ideal or more realistic return on investment? And you can see that here, desired rate of return on land investment, it should be realistic. We usually use 4 to 6%. So that's a return you can think of as if you invest in, let's say, another market like stock market or something, like what is your return on this land investment? So you need to, you probably calculate, just put that, consider that in your calculation as well. And the return on ownership, calculate that part. So one of the tricky part is the land current cash market value. For cropland, you need to have a realistic value to that note. Because if you value it like 10 grand per acre or 15 grand per acre, that will dramatically increase your cost of ownership. So just have a realistic for your ag land, have a realistic current market value to that. So total capital improvement allocated to each year, that could be, fencing, repairments, maintenance cost, uh, brush control, lime applications. Most of the time, the operators take care of that. But maybe something like gravels for parking or things like that need to be worked into the cost ownership as well. So then you have a total cost of ownership. That's item 7. And then just divide it by the number of tillable acres to be rented, or just divide it by the numbers of acreage that you are renting. And then give you a cost of ownership per acre. So that's equal to your desired land rental rate per acre. And I'll show you an example. So then in this example, the landlord is renting out 200 acres, value at $1,200. You think that what kind of land value that low here in Tennessee? Probably you can't really find that at all. But just in this example, the dollars per acre were valued at $1,200. So interest rate or return on investment, we are estimating 5%. So which means annually you're getting from your land 5% of rate of return on your investment. And then repairs, we are not including any in this example. Real estate tax rate, $12 per acre, and depreciation on your improvements. And that depends on your land, how it's developed, and what does that include. And you can include those also in the worksheet. So the total cost, looking at item 9, line 9, is around $14,000. And per acre cost divided by the 200 acres, we're looking at $72 per acre. And that's the cost of ownership. So that's pretty much how to calculate your bottom line of your cost of ownership. And then I also included cost of ownership of structures. These days, we're looking at a lot of greenhouses being built in Tennessee or just nationwide to extend production season. So a lot of times we are not only involved in renting our land, but also renting our equipment or structures on the land. So how to incorporate that into your base land rent. Now, so we're looking at how to calculate that. First, you need to consider depreciation, and that's a big part of cost of structures. Portion of the cost of building that is counted as an expense each year, and it's a way of spreading your initial cost of the building over its expected useful life. Again, you also need to think about return on your investment. Multiply the rate of return on investment and annual interest rate, what I just explained to you, by the current value of the building. So that's your return on investment. The interest rate can be based on the rate which your money or property loan, how the money is borrowed, the rate at which money can be invested. That's another way that I explained. But the general rule of thumb is between 4 to 6%, which is what we see in ag land or ag structures. And then we need to consider tax and insurance and greenhouse insurance, hoop house insurance, calculate that also into the equation. Repairs. If not known, if it's first year that you're renting out your structure, if not known, use a rate of 2 to 4% of replacement value of the building to calculate that into the equation. And if you already know your last year's repairs, you can just estimate that based on your last year's cost on repairment and estimate what it's going to look like for this coming year. Utilities, who pays the utilities? Usually for greenhouse or hoop house production, the tenant will pay the utilities. But if you cannot separate that from your main lines, maybe just think of a way to separate that responsibility and incorporate that if you are paying for the utilities. So I'm using a real example that a greenhouse owner in Davidson County actually, and we're looking at, so she's looking at renting this out. What is it going to be? So for greenhouse, usually that a rental rate is cost per gross square foot per month, or you can work out an annual lease and payment can be made monthly. So for in this example, the current market value for the greenhouse is $53,000 and the square footage is 30 by 90. And the remaining life, we're estimating 15 to 20 years, and we're looking at 15 years. So the depreciation is about $3,500. How is that calculated is divided the $53,000, the current market value, by the remaining life, 15 years. So you get your annual depreciation around 3,500. So rate of return on your investment, we are estimating 6%. We're expecting, that's a better word, we're expecting 6% and on the current market value. So the total rate of return is around $3,200. Tax and insurance valued around 1.5%. It's $800 plus so the total ownership in this case is $7,500. And annual repairs we're estimating 4%, which adds another $2,000. Utilities, the operator agrees to pay the utilities themselves, so we're not calculating any of the utilities in this example. So the total annual cost for ownership is around $9,620. And you can see a cash cost. I put it next to the total cost, which means it's really a cash out of your pocket kind of expense. That gives you an idea what is your bottom line to recoup that cash cost you're paying for annually on this greenhouse. So the square footage is 2,700 square feet. And then you divide it, the $9,000 by 2,700 square feet, and then by 12 months. So cost per square foot monthly rent is around 36 cents per square foot. So that's what we are proposing for the tenant, and just knowing that your cash cost or your bottom line is around like 10 cents per square footage. So you look at actually nationwide, and that's probably very reasonable to charge 10 cents to 35 cents per square footage for greenhouse production. So now you know what is your cost of ownership. It's really important to figure out how much can the tenant afford, because you can propose a 6% or 10%, 15% rate of return. But if your tenant cannot afford, it's really not a fair, reasonable rate for you to charge. So this example is for row crop production, how much the tenant can afford. So that requires you to know how much goes into cost of production per acre for row crop. And in this example, I'm not going to go by line, but in this example, the maximum what they can afford is around $103. So looking back in this example I just talked about, your bottom line is around $72, and how much they can afford is $103. So you knowing that for your negotiation is very important. What is reasonable between the two? And that really set up a good parameter for you to work with. Then tenant, we talk a lot about cost of ownership. For tenants, it's really important for you to know what is your break-even rental rate. Most of our row crop producers know that, and they have a good idea of their cost of production, but not just row crop. Cattle producers, greenhouse, or produce producers, you also need to calculate what is your break-even rental rate, and to have that available so you know that what you can afford. This is one of the free tool that developed by University of Minnesota called Fair Rent, and that's the link for that this tool. So it's useful tool for the operator to analyze their break even based on what is your yield expectations, what are some price scenarios you work into that calculation, and then it will give you different scenarios that you can look at. It's also used for landowners to understand how much they can afford. However, this tool requires a really good knowledge of the operation financials. So if you don't know how much they're spending on fertilizer per year, how much what is the yield or price looking at, this might be too much a complicated tool for you to utilize because it does require detailed information like that. And then we're looking at flexible cash lease. I spend fair amount of time on fixed cash. Now we're looking at flexible cash because for a lot of our landowners that I work with or talk to, they usually prefer the fixed cash over flexible cash. And the reasons I'll show you in the coming couple slides. So we talked about last time that flexible cash lease, the rent is tied to yield or gain, crop or livestock prices, or input cost. So what that means that you can base your rent on flexible for price and just fluctuate when livestock prices fluctuate or crop prices fluctuate. A calculation is you have a base rent and then a base price. And when the price move above that threshold or move under that threshold, and the cash rent will be adjusted based on that price change. So like I said, the base rent with schedule of adjustments for prices outside a specific range with upward or downward. And that will really require the landowner to have an idea what does crop prices, what does livestock prices looking at in the market right now. And looking at the past 10 years of data, and this is for row crop corn and soybeans. You can see during 2011 to 2013, the prices are real high, and it has been low for the past 5 years. And the little arrow I put at the end of the graph that shows what is the trend we're seeing recently. The crop prices are moving up, and hopefully we'll keep that trend. But for landowners, if you want these type of flexible cash rent based on price, you really need to keep up with what does it look like for the market, because it will create conflicts when you get your annual payment and it's not something you expected, and you're thinking, wow, this is not what I want, or this is way below what I want my land to generate. So you won't understand how is that calculated, and keeping up with the market price will solve those issues. So one example is looking at Montgomery County as an example. Base rent can be $120 per acre. That's the prevailing rate in Montgomery County for non-irrigated cropland. And so if the prices of soybeans between $10 and $11, that's where you're getting the base rent, $120 per acre. But if the price increase 50 cents per bushel, and then possibly rent can increase or decreases by $5 per acre. So another way you can set up is for adjust your rent for changes in yield or gain. Gain is looking at like livestock, yield is more like crop. So your cash rent is also based on a base rent, have adjustments if that yield is moving above that range. We're going to adjust that, and how we're going to adjust that. And then you're gonna be needing to looking at what is the average yield for your land for the past years. Or you can, so if you don't have that information, you can looking at the county average. USDA have those data available. And if you're interested, I can also send you a link for you to check what is the average yield for crop in your area. So you looking at corn and soybeans, the yield really doesn't fluctuate that much for the past 5 years because of technology, because of mainly because of technology, the yield doesn't really fluctuate that much, and really depends on the weather that your yield can go up or down within that range. So then again, you can put all those things together. You can have your rent flexible based on crop price, yield, and cost. Putting it really together really make it complicated, but also make it very fair. You can think that's very fair based on year to year situation because price change, yield change, and input costs changed quite a lot. And for this year, a lot of livestock owners that we're seeing the input costs is really raising for crop producers is the same as well. So you're only looking at the price. Oh, okay, so the price is looking good, but also keep in mind the input costs has also raised since that occurred. So then looking at farm input cost trend, what does it look like? It has been increasing for past 20 years. Annually, it's quite steady, increasing trend for fertilizer, for seed, for those technology that farmers have to pay to keep up with the yield. So input cost has been increasing. And then another example, putting these three pieces together. So if my base rent is $110, base price, we're looking at $11 per bushel for soybeans, and actual price, an actual average price the farmer received is $12 per bushel. And base yield, we're estimating 40 bushels per acre. And actual yield, actual went down a little bit. It could be because of weather. So we're looking at 36 in this example. And input costed, we're setting the baseline at $250 per acre. Actual cost actually went up to $260 per acre. So with all this prices or yield and input cost changes, would you estimate an increase in your rent or a decrease? You probably wouldn't know because you see the fluctuation is not that huge, significant that you'll be able to see it right away. But you put it down in paper, your base rent was $110 per acre. But your actual cash rent for this past year, you're looking at $94 per acre. How it really decreases in this example is mainly because of yield has decreased 4 bushels per acre. But just by looking at price, you would imagine, hey, I probably should receive more. But in this case, well, the weather, those risks, those fluctuation that farmers have to face, not just the price. You got to look at the bigger picture. So in this case, the cash rent actually decreased. So really create, this kind of transparency is really important for the landowner and to understand for the landowner to understand why your tenant is paying this much. Okay. And then we'll talk about crop or livestock share leases. Rent, we talked about last time, is a specific share of the crop or livestock produced. So one example using crop, because it's a very common method for crop, row crop to utilize is share arrangement or share agreement. Again, if you want to do the share arrangement or share agreement, you need to know your cost. You need to know what is your investment, what is your cost going to the land annually. The tenant need to show what is their cost of production, and then looking at the percentage of that total, putting that together, what is your costs percentage and what is the percentage of your tenants inputs into the land, and then that will give you the baseline or the percentage of your share. So your percentage, your share is based on percentage of your input, what you put into that production, and that is fair to receive the same percent of crop share based on that. So lastly, we talked about hybrid leases is some combination of the cash leases and some share leases. And one example we can look at is greenhouse. The base rent is predetermined by square footage. And then also a plus percentage of gross um, um, to that revenue. So for example, this example is actually not greenhouse. It's one example I work with a Montgomery County cattle producers and the landowner. So we sit down together and look at if this is fair for both of them. So it's really small acreage, 12 acres of pasture in Montgomery County. Base rent, we're looking at $25 per acre, and that is the prevailing rent in the area, the average rent in the area, plus the proceeds of one calf. So the producer, the owner really value the or charity work or donation work, and they wanted to donate the proceed of one calf to the community, and the producer also agree that to do that. So what is the value of the one calf? That is something, we didn't discuss. What is the weight of the calf? Is there something that you expect? But if we're looking at a small calf, $150 per hundredweight, we possibly looking at $500 possibly for that maybe 300 or 400 pounds of calf. So that as to rent for 12 acres, another $500. So that $500 divided by 12 acres, that's around 35 plus the $25 base rent. You're actually looking at $60 per acre for that pasture land. So that's very good rent, very good, or a fair rate. I won't say a good rent, a fair rate agreed upon the two. So when we talk about fair, what's the difference with that with equal? Because fair is both of the party agree upon and happy with. Okay. All right, so that's pretty much it. And putting it together, owners need to have a clear understanding of their cost. And this session, we talk about how to calculate your cost and knowing that. Tenants should have production records that will allow them to determine how much they can afford to pay. And communication is key. Sit down, have that transparency, and just listen to each other. And understanding cost of production is really important for the owners to understand what is going into your land and what to expect. And I'll hand over to Chris. I think Chris have some messages to take home as well.
Thank you, Iris. That was great. I want to also try to answer. We've had a couple of questions in the chat box, and so I'm going to try to answer those as well. But obviously, if you have additional questions, please add them. Um, really, I just very quickly, three take-home messages in my mind. The first is crop insurance and other subsidies can complicate everything that Iris just talked about, and we don't have time to talk about everything in 30 minutes or 45 minutes, but that's something that's out there. Um, the second is, and this question may seem strange to you guys, but why the focus on fairness in terms of rental rates, and are there limitations in terms of fairness as a factor in determining rental rates, and this the reason why it's a question that I think I ask is because I did spend 4 years or so working for a large law firm where primarily I worked on leasing situations, and we didn't worry a lot about the fairness of rental rates. Clients weren't very interested in having a fair rate, right? They were interested in having the best rate for them, and to a certain extent, it makes sense that you see a lot more concern about fairness in the farmland context because farmers and typically landlords live in a community, and those leasing negotiations and the terms of the lease can influence their reputation and standing in the community and the relationships with their friends and neighbors. So it makes sense that there's a lot more concern about fairness in that context. Another aspect is because you see a lot of this information comes from extension publications where the extension is trying to sort of play a middle role between landlords and tenants, and also a culture of fairness. It may help reduce attorneys' fees, right? If everyone's trying to be fair with each other, then maybe you don't need as much from an attorney. But I would say that fairness is a little bit limited, and Iris is done a great job, I think, of highlighting that because it is a subjective concept, and landlord's notion of fairness may not quite match the tenant's notion. And when attorneys talk about fairness, they often break it down into two different ways of looking at the question: procedural fairness versus substantive fairness. And procedural fairness is about the process by which in this case, the rental rate was agreed upon. And so that would go to questions like, did both parties have access to the relevant information? Was the bargaining power between the parties relatively equal? Or did one party have a lot more power in this negotiation than the other? Um, and what was the level of sophistication? Um, and so those are things that you might look at in thinking about fairness. The other aspect would be substantive fairness, and that was whether the outcome is equitable or fair to the parties. And that's really what the three methods that Iris has talked about tries to get at, is to answer that question. And really what that provides, it's not that you're going to go out and identify a single measure, a single fair rental rate, but that you're going to identify this range of rental rates that are more or less likely to be considered fair by one or both of the parties. Um, and my third and final point, and it relates to the question, and that's so identifying, it's obvious from listening to Iris that identifying and negotiating an appropriate or fair rental rate, it really depends upon your access to information and your ability to analyze that information. And so one logical question is, where can you go to get access to that information and potentially help in analyzing it? And the question in the chat was, how do you determine fair market value of land? And so that's a perfect example of, okay, where do we go to get information about this? Uh, and before I forget that, well, I made notes as I thought about this. In terms of determining a fair value for land, the the smart aleck easiest thing to say is you try to sell it, right? That'll tell you what it's worth. Um, but that's probably a little more, that may defeat the purpose of why you want to know. At the more expensive end, you could pay for a valuation. There are people out there who value farmland, and you can obtain a valuation from them. It's probably going to be more costly than you want to spend in most instances, But if you do purchase that service, what they're going to do is they're going to go out and try to look for sales of similar land to what it is you're asking to value. And to a certain extent, you can do that yourself. Um, the the easiest source of information on the easiest for you to obtain is a tax assessment, right? You're going to receive a tax assessment every year that's going to try to it's going to roughly it's going to try to um, the tax assessment process is going to try to value that land, the fair market value of that land. Um, you have to be a little bit careful with assessments for a few reasons. The first is land in Tennessee is reassessed every 5 years. Each county goes through this reassessment process. And I really shouldn't say land. The county goes through a reassessment process every 5 years. And the closer you are to that reassessment process in your county, probably the more accurate it's going to be of more accurate representation of the value of your farmland. Um, the second thing, and this was the follow-up question, when you look at an assessment, you've got to be careful to distinguish between, for farmland, between the fair market value and the value of that land as farmland, or what is often called the green belt. So if your farmland is classified as farmland, then you receive a reduction in the property taxes that you pay on that. And the way the state does that is it reduces your assessment to represent not the value that the land would would be sold at if sold to a willing buyer on a fair market, but what the value of that land is ag land. And so when you look at that assessment, you got to make sure as to which number you're looking at to understand, are you getting the ag land value or the fair market value? If your land is, if there's no development pressure on your land, if it's away from, it's not close to any urban area, then those values may be very close or even the same, and it's not an issue. Um, in terms of assessment, there is also again, you get a tax bill, so you're going to see your assessment, but there's an easy way to look for other assessments in your county. And I'm just going to try to share my screen and show that with you. Are you seeing the real estate assessment data page?
Yes.
Yes. And so you can click on this. And so just as an example, so property taxes are public information. So we can go and see what everyone's land in the state is assessed um, for. And so you can click on any county, pick in Cumberland, and let's say just coming, we can search Smith. So let's find something. So we see the class, and so pick out some farmland here, select this person's, and you see this, the market value, improvement value, and you can also see some sale information. And so if you know of a parcel or property in your county that's recently sold, it's very easy to use this database to go see what it sold for. And so that's a nice way to give you um, information on those values. And you'll note it breaks it down between improvements and land value. And so you got to be careful when you look at this. And this isn't green belt. So this is, I guess there's ag land and there's farmland. And that's what one of them qualifies for green belt and one doesn't. And I can never remember which it is. So ag land must be green belt. So when we click on this one, yes. So here we see the market value. So this is meant to be the fair market value, and this is the use value. This is the attempt to value that land as ag land. And so the follow-up question in the chat was, for the purposes of determining a fair rental rate, which would be the more appropriate value to use? Is it the market value or is it the use value, the value of the land as farmland? Um, again, there's no necessarily a clear answer to that. If you're a landlord, you might argue it's the market value. If you're a tenant, you're probably going to argue the fair thing is the use value. I would say that as you look at the extension resources I've looked at, they tend to say that it should be the use value because you're leasing it to an ag operation. Okay. Other questions? Stop share.
Do we have any other questions? Okay. If not, I'm gonna just ask you two questions here on the screen. And thank you, Chris, so much for the valuable information and answer some questions. Next Thursday, we'll be talking about legal considerations. So, Chris will talk about the legal aspect of leasing your farmland. We hope everyone will join us next Thursday.
And I forgot to mention one other thing to think about in terms of ag land is you can basically reverse what Iris did to calculate fair rental rates. And so if you think about those average rental rates per county, if you divide that by that 4 to 6% ratio that Iris talked about, that gives you a very rough estimate of what the average value for farmland in that county is. And so for the example Iris had for Montgomery County, I think it was $120. So if we take $120 and divide that by, we'll just say 0.05%, that's $2,400. And so that's a rough estimate if you, to
Mhm.
the extent you believe those averages of what the average value of farmland in Montgomery County is. And again, there'd be a range because it's not clear what that percentage should be. Should it be 4%, 5%, 6%?
Yeah, because for $2,400 an acre, it's gonna be very tough to find
Yeah.
find agricultural land in
A-
Montgomery County.
And that's very rough because again, I didn't, there were other expenses that should also be added into there, like property taxes and all, and those other things, right? That would go in and would drive that value up a little bit.
Hmm.
You would just do the exact opposite, go in the exact opposite direction of what you did to get the rental rate. Is you'd start with the rental rate and you could work backwards and get the land value.
Hmm. All right. I don't see any questions. Thank you guys for joining us and see you next Thursday. Thank you,
Thank
Chris.
you. Thank you.